In today's webinar, we're going to discuss the host of topics related to the residential mortgage process. Thanks for joining me today, so let's begin. Firstly, let me tell you a little bit about myself and my experience. I've been a residential mortgage banker and/or broker for about 22 years. My specialty is co-op and condominium transactions, but I'm well-versed at 1 to 4 family mortgages as well. It's pretty incredible what I've seen in this industry over that span of time. Multiple refinance booms, the market crash of 2008, wild swings in the interest rate market, and how banks have done full 180s on how to underwrite and approve loans. There isn't much that I haven't seen as far as market factors and different loan scenarios. Calm seas never made a great sailor could be my mantra over my career. I spent 12 and a half years at my first job, cutting my teeth as a mortgage broker, working with many banks through the wholesale channel to place loans for clients. After the 2008 crisis, there was a tremendous shift away from mortgage brokers. Many of the larger commercial institutions ceased doing business with brokers, and we no longer had the variety of lenders to choose from that made us competitive in the market. Correspondent lenders who act as a bank became much more attractive, more autonomy, and those lenders still had access to the large commercial institutions. I left that company in late 2013, spent over 9 years at the next company, acting as a banker and broker, learning and understanding the ins and outs of what it's like to operate like a bank that underwrites its own loans. This was a terrific learning experience and made me a much more well-rounded loan officer. I then made the move to cross-country in April of 2022 for a variety of reasons that I will go into detail on. All that time, I worked closely with clients, processing and closing departments to move the loan through the process, update the clients, real estate agents, attorneys, etc., along the way, and help shepherd the clients to the finish line and through closing. Always deeply involved, trying to create the best experience possible through a complex and oftentimes difficult process. If I had to describe in a few words the type of loan officer that I am, taking into account the incredible bias we all feel about ourselves, it would be as follows: organized, efficient, friendly, educator, avid advocate for my clients, team player, leader, always searching for a better, more efficient way. Like I explained previously, the experiences that I've had over the last 22 years has led me to almost anything and everything that can and will happen in this industry. In my humble opinion, there is no price tag that you can put on that experience. So in general terms, here are today's topics. What factors lead people to choose a particular lender? We're going to take a behind-the-scenes look that you won't get anywhere else. How the loan process works and the many possible pitfalls within the mortgage process. And lastly, how CrossCountry has the right solutions to avoid or prevent these pitfalls and create as seamless a process as the industry has to offer. So if you're signed up for this webinar, you probably fall into one of the two following categories. One, you want to be educated about the mortgage process for a possible purchase or refinance. Two, you need help right now obtaining a mortgage. For either category you fall into, you've come to the right place. Let me start by saying I truly appreciate that you've taken the time to sign up and listen to my webinar for the next 20 minutes or so. I assure you that it will be educational and enlightening, and you'll have a much better grasp on not only the mortgage process, but be in a much better position to make the right choice when you need to obtain a loan. So let's get started. As you're all aware, we live in a fast-paced digital world which is changing and shifting beneath our feet with every passing minute. The internet, social media sites, a workforce shifting to the home. All these things are not only changing, but shortening our attention spans, with most people now conditioned to search for expedient solutions. Unfortunately, the mortgage industry was one that struggled to get a handle on technology and innovative ways it could improve the process. But that's not hard to understand when you realize how many moving pieces there are when it comes to closing a mortgage loan. For a long while, mortgages didn't fit into the world of technology can make things better. It relied on somewhat of an antiquated system, shuffling paper around from person to person, slowly making progress along the way, with the loan officer at the center of the transaction, letting everybody know what's going on or not going on. From the very beginning of my career, I was a loan officer dedicated to making the process better and doing my best to educate my borrowers along the way. Always researching and analyzing my own personal experiences over 2 decades as a loan officer in New York City. All that has brought me to this moment, to this company, to be able to impart to you so much of what I've learned. Over that time, it's become abundantly clear to me that many people who apply for mortgage financing go into the process with certain preconceived notions about how and why they choose a particular lender. I've learned that the two predominant items are interest rate and closing costs. It's also interesting to note that this has become even more prevalent over the past few years. I now understand why more and more people think this way. It's simple, straightforward, easy to understand and compare, and fulfills our brain's modern requirement for an expedient solution. Here's the problem. Mortgage borrowers aren't told, exposed to, or want to take the time to understand the mortgage process as a whole. A good analogy for the mortgage process is that it's like a jigsaw puzzle. If the pieces don't fit together, the puzzle can't be complete. There's no such thing as cutting corners. That journey to understand the mortgage process and the decision-making factors that people take into account is the driving force of this webinar. After watching this webinar, you will never have to say, I was caught by surprise with everything I experienced in the process, and if I had to do it over again, I'd choose differently. I assure you that the time invested will be very well spent, and you may even change your preconceived notions of why you choose a particular lender. So here's a great rule of thumb to always remember. Choosing your lender predominantly based on rate and closing costs is both short-sighted and a mistake. This is so important that I want to repeat it, have you hear it and read it twice. Choosing your lender based predominantly on rate and closing costs is both short-sighted and a mistake. When shopping for a mortgage, one of the big mistakes people make is treating the mortgage like it's a commodity, when it is in fact nothing like that. So when you choose a lender predominantly based on interest rate, you're commoditizing something that isn't a commodity. You're in fact doing yourself a big disservice. You cannot shop for a mortgage and walk out with it the same day. It's not a carton of milk. It's not a cup of coffee, a screwdriver, or a refrigerator. The mortgage process can be long and complex. You have to rely on multiple people to all be working towards the same goal: attorney, loan officer, real estate agent, appraiser, bank attorney, house inspector, just to name a few. I have learned painstakingly in some instances that there are a few of what I like to call golden truths when it comes to mortgages and mortgage companies. Some of you may be aware of, and others you may not. The incredible value to you here is that I can take all these critical lessons learned over a long career and crystallize it so you can reap the benefits. So let's take a behind the scenes look. Number one, your mortgage company must have good bones. 2, A loan officer must be organized, efficient, and effective. 3, don't get the wrong appraiser. 4, beware of the shiny object syndrome in regard to rates. As I said, your mortgage company must have good bones. So what does that term good bones or great bones mean? I thought it quite appropriate to talk in terms of real estate. What does it mean when we ask, does a house have good bones? Let's look at the definition. When evaluating a home, buyers need to look beyond the carefully curated facade to discover the house's underlying qualities, its bones. In the real estate and construction industries, a house is described as having good bones if it doesn't have any major defects that could lead to expensive repairs. To put it simply, despite how good the cosmetics of the home may look inside and out, if the foundation isn't solid, you're going to have all kinds of issues in the short and the long run. And this is the perfect analogy when it comes to whom you select to obtain the mortgage for you. On the surface, a loan officer may be a wonderful salesman and tell you everything you want to hear. We've got terrific rates. Nobody can beat our rates. We've got top-notch customer service. Nobody does a better and more efficient job than us. We have a seamless process. Nobody can get you to the closing table as easily and as quickly as we can. We have excellent communication. I'll keep you and everyone informed every step of the way. Sounds to me like they know what they're doing, and you're going to get a good deal, right? Sounds like they have their act together and have good bones. Let me let you in on a little secret. It doesn't matter what the loan officer says or even how good the loan officer is at their job. The best loan officers in the world cannot get the job done well unless the bones and the foundation of the company are solid. You know what happens when the bones aren't good? Continue to bang your head against the wall and have difficult conversations with clients because the company can't get the job done. That terrific rate may not even be there when the loan goes to closing. That, quote, seamless process turns into a very displeasing process and delays. So let's talk about that in greater detail. What makes for good bones in a mortgage company? Technologically advanced loan operating system, staffing, delegation, and ownership that's on the ball. Let's talk about technologically advanced loan operating system. This is the lifeblood of a mortgage company. A loan operating system is defined as a system that automates and manages the end-to-end steps in the loan process, from the application through underwriting, approval, documentation, pricing, funding, and administration. A good analogy I like to use is that the loan operating system is a chassis from which you can build a car. Like any other industry, there are many types of loan operating system chassis to choose from. Some loan operating systems integrate with amazing software, and others have the ability to just use basic software. For me, it comes down to two choices for the company. Do you have the means and will to invest in a top-end loan operating system? Or are you going to choose a chassis in which the software allows you to build a car that stalls coming out of the showroom, or a high-end precision vehicle like a Ferrari? If you have the means and invest in the right system and software, you have built a Ferrari-type loan operating system, putting you at the top of the mortgage industry food chain. Let's not kid ourselves, though. Being at the top of the food chain requires significant investment in not only the system, but the proper manpower and well-trained employees to implement it properly. Many companies don't have the ability or will to either implement or maintain that type of system. So let's break this down a little further so you understand all that a quality loan operating system can do for you as the borrower and the company as well. Here are three keys: onboarding software for the loan application and client documentation, artificial intelligence, and milestone updates. Let's talk about onboarding software for the loan application and client documentation. With the click of a button in the email signature, you're taken right to a user-friendly portal where you fill out your application, securely connect to your bank accounts to verify assets, and automatically initiate income and employment verification in most cases. What is the cross-country advantage and value to you as the borrower? In most instances, you'll never need to upload, copy, and save, download, save and upload, or any combination thereof of bank statements or retirement accounts. Once you give us secure access, a digitally generated statement flows right into our system. If the statements on file expire, we automatically generate new ones without having to ask you for them. In most instances where you're a W-2 base salaried employee, we can eliminate the need for you to send us W-2s, pay stubs, and tax returns. This streamlines and simplifies the initial approval process for both the borrower and the company. CrossCountry Mortgage has the loan operating system in place that accomplishes all of this. Our mantra is to create a wow factor for you by simplifying, organizing, and coordinating your loan from application to closing with as few hiccups as possible. Artificial intelligence. This is a term we've all heard for years. Whether it be advances we hear about on the news, seen on the Discovery Channel, or in the movies. For those technologically advanced companies that have the means and will, this technology is now available to be applied to your mortgage. For many loan programs, AI analyzes documents uploaded into the loan operating system and provides consistent underwriting conditions based on the provided documentation. After checking up to 40,000 data points, the system notifies the company of certain but not all file conditions before review by an underwriter. Yes, you read that and heard that correctly. Before underwriter review. When additional documentation is uploaded, the applicable conditions are cleared and the file is reconditioned if necessary. This technology is really fantastic with self-employed borrowers who have very complicated tax returns. It will scan the documents and immediately figure out what the actual income is based on mortgage underwriting guidelines. So what does this mean in a nutshell? Certain documentation that's uploaded into the system will be scanned, processed, automatically listed as a condition on the loan approval, and in some cases, those conditions will be cleared without an underwriter needing to look at it or approve it. In addition, AI will scan the tax returns, read them, analyze the income, and return an exact verifiable income number based on banks' guidelines. I cannot underestimate the value of this when it comes to the loan process. Some returns are very large and extremely difficult to break down. Complicating matters is that each return is prepared by different accountants who have varying degrees of knowledge and skill. Because of this, loan officers, processors, and underwriters have always struggled to read a tax return properly. This is now a tremendous time saver, making the loan more efficient as well. What is the cross-country advantage and value to you as a borrower? It ensures reviews for accuracy. Income is calculated automatically, eliminating inaccuracies on the application and processing times. It decreases processing wait time and leads to faster underwriting turn times. It is well known industry-wide that one of the chief complaints for borrowers and others involved in the transaction is not being kept in the loop on what's happening in real time. Milestone updates eliminate that problem. For many loan operating systems, to have the update work in the exact fashion the loan officer wants, these updates must be custom built from scratch. They can include: loan has been submitted for processing, loan is conditionally approved, loan is cleared to close, loan is closed. What is the cross-country advantage and value to you as the borrower? No need to wonder what's happening with the loan. Everyone important to the loan is on the same page in real time. Our system will send out a custom-made video created by me, letting you know that the milestone has been reached. This update can be sent to not only the client, but the real estate agent and the attorney. This is not something that a borrower typically would think about, but it does play an important role in your process. A long and well-known issue within the industry is the quantity and quality of staffing. The mortgage business has great ebbs and flows, and typically mortgage companies are too slow to adapt on the fly. For example, interest rates plummet, and before you know it, we're in a refinance boom. Millions of people across the country are now applying for new loans, and the banks are caught off guard. Not enough processors or underwriters to keep up with the demand. This slows the process and leads to inefficiencies. The banks start to ramp up with new hires, who of course need to be trained properly. Oftentimes, by the time the new staff is hired, trained, and up and running, things slow down, and now you've got all this additional staff that you needed weeks or months ago. So they lay off employees, and this vicious cycle continues. What is the cross-country advantage and value to you as the borrower? Cross-country mortgage has a different philosophy. Always be fully staffed, commensurate with being extremely busy and ready to go, regardless of how busy the market is. We are always properly staffed so that your loan can move through the process quickly and efficiently, no matter how busy or slow the market may be. One unhappy client is one too many. Okay, good bones. Item number 3, delegation. Just from the few things we've discussed so far, it should be obvious by now the mortgage process is not an easy one. It involves multiple people working together, all towards the same goal. That's why delegation of tasks within a company is so crucial. Each employee is a cog in the wheel who has a defined set of duties and responsibilities. Like a finely tuned assembly line working to get your loan closed quickly and efficiently. Again, what is the cross-country advantage and value to you as the borrower? Everyone at Cross-Country Mortgage understands their clearly defined roles. This makes it much easier to track and quantify when something has gone wrong. Finding and correcting issues is now much simpler. Like everything else mentioned so far, it's another in a long line of processes aimed at bettering the client's loan experience. Okay, good bones item number 4, ownership that's on the ball. While I cannot speak for the ownership of other companies, I can certainly speak for ours. Ron Leonhardt Jr. founded Cross Country Mortgage in 2003 after having worked several years as a loan officer and broker. Under his leadership, Cross Country has become one of the nation's largest and fastest growing retail mortgage lenders and the largest based in Ohio. Leonhardt created a leading mortgage company by breaking the mold, outworking the competition, embracing risk, and converting ideas into reality. The company employs nearly 7,000 across its network of more than 500 office locations nationwide. In 2020, it funded $42.65 billion in home purchases and refinance packages, representing almost a 200% growth year over year, ranking third among Housing Wire's top 15 mortgage lenders. He attributes his success to embracing rather than resisting change. What is the cross-country advantage and value to you as the borrower? A national company founded by a loan officer who understands what it takes to be successful. Ownership that understands the need for being on the cutting edge of technology. An understanding that a solid team backed up by an excellent system is what makes for a smooth and efficient process. A philosophy that appreciates everyone's worth, that's team-oriented. Let's discuss another area that's crucial to an efficient and pleasant process. Mortgage pitfalls and how to avoid them. This is another area of the process that's crucial to discuss and for you to hear. I will take you behind the scenes to learn about those parts of the process that are almost never discussed between loan officer and the borrower, which shows common weaknesses within our industry. Qualifying the loan applicants, taking and data entering the loan application, collecting loan documents, the appraisal process, loan approval process, and shiny object syndrome regarding interest rates. So let's talk about qualifying the loan applicant. This is the most basic and probably most important function for the loan officer, and it's truly amazing just how often I've had clients come to me saying the following. I went to Bank XYZ and they pre-qualified me prior to me signing a contract. Once it was signed, I applied for the loan, immediately paid for the application fee and appraisal, and 4 weeks later, they rejected my loan. Now I'm 30 days into the process with no approval and out of pocket X amount of dollars. Please help. To avoid that, the loan officer must be proficient at discussing and analyzing income, assets, and credit, and can diligently qualify any client within a 15 to 25-minute phone call. This comes from literally qualifying thousands of clients over my career. It is truly the basis of starting any loan process off on the right foot. Excuse me. If I were to detail even some of the areas where things can go awry during this time, we'd be here for days. The best way to simplify this is to say all loans are like jigsaw puzzles. All the pieces must fit together to make it work, and even if one piece is missing, the puzzle cannot be completed. I'm sure you've all heard the term garbage in, garbage out. That is so appropriate for this process. If the loan officer isn't doing their job properly, then the person isn't qualified correctly, then the loan will not be approved, the borrower is back at square one, needs to find a new bank, etc., etc., etc. You get the point. Some of the most dangerous words in our business can be, sure, no problem, we can do that. Don't say it unless you know it to be true. Let's talk about taking and data entering the loan application. There are several ways a loan officer can take an application. Some of them are very efficient and others not. They vary from, but not limited to, 1, send all application questions to the applicants so they can respond via email and then have the company data enter that information into the loan operating system. 2, give the client an electronic link that takes them to a user-friendly interactive system where they can answer questions, fill out information, and have that application automatically uploaded into the loan operating system. Every loan officer is different and has their preferred method on how they want to take the application. Most companies give leeway to the loan officer as long as at the end of the day, that loan application is completed before being submitted for processing. Okay, so what are the potential pitfalls? Excuse me. Sorry about that. What are the potential pitfalls? The old school way of taking an application are mostly outdated, less efficient, subject to more errors, and takes more time to be completed. The electronic link eliminated the need to have an extended phone call during the work week, which we know in this day and age is more and more difficult to accomplish. The applicants can fill it out at their leisure, whether it's during the workday, after hours, or on the weekend. Not all interactive systems with an electronic link are built alike, and none of them are perfect. Some systems don't ask nearly as many application questions as others. So although you may have answered each and every question, you cannot assume the application is complete. The loan officer will have to review the application, follow up with the applicants, and fill out whatever is missing. This is, of course, requires more phone calls or emails, another layer of inefficiency. What is the cross-country advantage and value to you as the borrower? Cross-country mortgage uses an interactive system where if you answer each and every question, the loan application, in most cases, should be complete. From time to time, there may be some follow-up that's needed. It's technologically on the cutting edge, seamless, and the most efficient system the industry has to offer. Okay, collecting loan documents. There are lots of different kinds of documents to be collected by the loan officer. These types of documents can include, but are not limited to, pay stubs, W-2s, tax returns, bank statements, ID, credit card authorization, building documents such as condos and co-ops, mortgage statements, insurance statements, common charges, maintenance, or tax bills. Just like taking the application, there are several ways a loan officer can receive documents. Some of them are very efficient and others not. They vary from, but are not limited to, have the loan operating system automatically send you a list of the documentation needed based on the data you enter and questions you answer in the interface. The loan officer sends you a list of what needs to be sent and asks to send it via email or regular mail. Like the application, most companies give leeway to the loan officer, as long as at the end of the day, the loan documents are put in the loan operating system. Okay, so what are the possible pitfalls? If the list of documents is being prepared by the loan officer, that's already an extra step. Many times the documents list is custom to the client and their financial pedigree. That takes time to prepare. If the documents aren't uploaded into the operating system directly, the loan officer or a team member has to take the time to get those documents onto the computer, then be put into the loan operating system. Or worse, those documents have to be printed out, scanned onto the computer, and then put into the loan operating system. What if the loan officer is busy or on vacation? Those documents are sitting somewhere other than the loan operating system where they are supposed to be. What if the team is busy, or worse, the loan officer doesn't have a dedicated team to upload into the loan operating system in a timely fashion? When ordering credit, many loan operating systems do not give the client the option to have credit run automatically when filling out the application. Again, what is the cross-country advantage and value to you as the borrower? Cross-country mortgage uses an interactive system where once the loan application is completed through the interface, you will automatically receive a list of documentation needed for your loan based on the data that was entered. No waiting for the loan officer or a team member to send you a list. No worrying that the list is incorrect for the first round of document gathering. It's technologically on the cutting edge, seamless, and the most efficient system the industry has to offer. In many instances, if you're a base salaried applicant, The system can automatically run credit and verify employment, possibly eliminating the need for any income documents such as pay stubs, W-2s, or tax returns. As discussed before, if you allow access to your bank accounts, in many instances, we will not need you to upload one bank statement ever. If the applicant allows you to run the credit to be run automatically, there is no need to wait for the loan officer or team to manually run credit once the application is done. All right, the appraisal process. Once again, let's go behind the scenes and talk about a process that almost never gets discussed, but can have a big impact on your loan. All appraisals have to be ordered through an AMC or an appraisal management company. The AMC works with lenders and appraisers to facilitate the ordering, tracking, quality control, and delivery of appraisal reports. Yet, not all AMCs are built alike, and here's how I know this. I have had a close relationship with a local, well-known and respected appraiser for the last 20 years, who's told me about the inner workings of AMCs. 1. Most of the large commercial financial institutions prioritize choosing the appraisers within their AMC based on price. 2. Appraisers who want to apply to the AMC are told what the maximum amount they can receive is. 3. Many of the better, more well-respected appraisers will not apply to these AMCs because the amounts they get paid are below what the quality of their work is worth. And 4, I have also seen firsthand that some appraisers are chosen from areas long distances from the house being appraised and don't know the ins and outs of that particular neighborhood. Okay, let's look at the possible pitfalls. Inferior appraisers lead to inferior appraisals. Inferior appraisals can lead to an appraised value below the purchase price. If the appraised value comes in lower than the purchase price, then the bank will only lend a percentage of the lower of the purchase price or the appraised value. So, for example, purchase price of $750,000, loan amount of $600,000 with a 20% down payment, appraised value of $700,000. Bank will only lend 80% of $700,000 or $560,000. Borrower would have to come up with an additional $40,000. In these types of situations, the options are never optimal. Go back to the seller to try and renegotiate the price, which is always difficult. Additional unexpected out-of-pocket for down payment, $40,000. Borrower to incur a higher rate and mortgage insurance, because you are now attempting to borrow 85.7% based on a value of $700,000 and a loan of $600,000. If the bank will approve that, rates are higher for loans over 80% financing, and you would then have to pay additional monthly mortgage insurance because you're borrowing more than 80%. What is the cross-country advantage and value to you as the borrower? Cross-country's AMC carefully selects local appraisers that know and understand the local community. Each appraiser is considered an expert in regards to not only neighborhood, but property type. As I'm sure you know, condos and co-ops in and around New York City are abundant, and the appraisers chosen understand that market very well. The AMC does not limit the appraiser by price, and much less likely that cross-country's appraisers will provide inferior product and lower appraised values. Okay, the loan approval process. Once the application is completed, documents for income, assets, and credit have been collected, and the loan is ready to be processed. But the loan must be disclosed. That means a set of federally mandated disclosures are sent to the borrower for e-signature. Once signed, we can lawfully move the loan into process, ordering the appraisal, and then send it to an underwriter who will carefully and methodically go through the application and any corresponding income, assets, or credit documents, excuse me, prior to rendering a credit decision. Okay, what are the possible pitfalls here? There can be a litany of issues on the loan application, excuse me, such as spelling mistakes, mathematical mistakes such as loan amount and purchase price, missing or incorrect employment information, missing or incorrect income information, missing bank statements or incorrect amounts, missing income documents, insufficient proof of funds for closing, missing residential real estate owned that's on the tax returns, missing or incorrect carrying cost documentation for real estate owned. Any and all of these items will force the underwriter to spend more time on the file, require that any or all of these mistakes be corrected, in some cases require that certain additional documentation be given before rendering a credit decision. When the underwriter issues an approval, there may be conditions to be cleared, which of course can take great time and effort, and also make the underwriter very unhappy. Yes, underwriters are everyday people like you and me. So you can guess what possible pitfalls can happen from here. The underwriter has to write up all the issues and send back to the loan officer and/or team. The loan officer and/or team has to take the time to discuss this amongst themselves and maybe with the underwriter as well. Look it over and have a plan of action in place to deal with it. Make the necessary changes, request updated documentation from the applicant or applicants, receive and review those documents prior to submitting to the underwriter. Once received by the underwriter, it typically goes back in the queue to be reviewed in time. This is very efficient, time wasted, and the loan officer, underwriter, and most importantly, you, the applicant, are upset. What is the CCM advantage and value to you? Remember the phrase garbage in, garbage out? It's never more appropriate than here. From the very beginning, CCM sets up the loan and application properly using the right technology that avoids many of these mistakes. CCM efficiency and technology through AI and an automated verification of employment allow for the underwriter to have a much simpler and quicker underwrite. Simpler underwrite will also contribute to a quicker and more efficient loan from that point through closing. It's a fair statement to say that no process or technology is perfect. Issues do come up, and sometimes they're unavoidable. But if the loan officer and technology are second to none, it greatly increases the odds that your loan will be prepared properly. Okay, let's talk about the shiny object syndrome, which I had mentioned earlier, interest rates. Remember I had mentioned this a while back? What does this term mean, and how does it relate to your mortgage? Shiny object syndrome occurs when companies neglect what's really important because they're focusing your attention on something else. If they can focus your attention on the shiny object, which is the supposed fantastic rate, they no longer have to worry about other dull considerations, excuse me, like technology, efficiency, proficiency, strategy, process, proper delegation, competent employees, competent processes. Bright, shiny objects are exciting for the consumer, easy to digest, but they are nothing more than empty calories. They want you to focus on only that one thing, that low interest rate, because in many instances, they can't deliver anything else. Let's face reality. We've all seen this before at varying times in our lives. The lowest price often means the worst service, and the worst service often doesn't equal the lowest price in the long run. Make no mistake, the mortgage product you're buying is a package. That's the process to complete your mortgage and all that goes into it. You need a new faucet for your kitchen sink. You can save money by buying the cheaper faucet, but in the long run, when that product fails, and it will fail, what was the real cost to you? Probably as much as the better faucet because you have to replace the crappy one. Buying the more expensive one may not cost you an extra penny in the long run, and it certainly comes without aggravation. You need a new swing set for the kids for the backyard. You want it to be large, interactive, and fun, but it doesn't come assembled. Just another job for dad. Remember, you're buying a package that contains all the parts needed to put it together. If one of the parts is missing, can you complete the swing set? No, you can't. So, what are the possible pitfalls? Can they deliver the rate they locked by the time the closing happens? As we already know, inefficiencies within a system can cause delays and issues with the following, which we touched upon before: application, appraisal, approval, underwriting. This is a very important part of the loan process, so let's get into more detail on this. For this scenario, both parties are ready to close on the purchase and everyone's waiting for the bank. They've had issues getting the loan to this point. Delays in completing the application, delays in getting the loan into process because the loan officer went away for a long weekend. The appraiser made some mistakes on the report, picked up by the underwriter. The appraisal company had to get involved to review and confirm the mistakes and get it back over to the bank. It was further delayed because the appraiser was busy, and then there was a holiday weekend. The underwriter had to spend an inordinate amount of time going over the application and had to add 8 conditions to be satisfied by the borrower, and so on and so on. So, as far as the interest rate lock, very important to talk about. How long is the lock good for? Most home purchase contracts signed in New York have an on or about closing date of 60 days from the signing of the contract. That is not a set in stone date, and both parties can delay upwards of 30 days and maybe more. This is especially true in the case of condos and co-ops. Some loan officers do not take this into account when offering a rate to borrowers. A 30, 45, or 60-day lock are meaningless if there's a very good chance the loan will not close within that time period. So let's look at a common scenario. Your loan has been locked and is expiring through no fault of your own, and the bank isn't ready to close. What happens? You're now in a situation where there aren't many great options. Here are some of the most common. Your lock is expired and you are now subject to a higher rate than when we originally locked. Your lock is expired and there are extension fees in order to maintain that interest rate. Those fees are not cheap and vary depending upon the lender and how much extra time you need. Your lock is expired, but rates are better now, so we can extend your current rate for X days at no cost to you. I've been told these exact scenarios took place many times by former clients who obtained their mortgage with other banks. Yes, you can get lucky if rates move down, but it's a real risk. The bottom line is that it's more of a risk to lose your lock and be subject to possible extension fees and a higher rate when you choose someone whose process is inferior or have a loan officer guiding the deal who's either made bad decisions, given you faulty advice, or no advice at all when it comes to when to lock the rate. So what is the cross-country advantage and value to you as the borrower? This is really less of a company answer and more of a loan officer-centric answer. I pay particular attention to having lengthy discussions with borrowers about rates, where they currently are in the process, the property type, and when may be a good time to lock the interest rate. As stated, all factors in when to lock a rate. So, for example, if the borrowers are buying a co-op where there's extra layers of complexity and time needed with a board package, interviews and approvals, here's the advice I typically give. Understand that you're buying a co-op and there's a lot of X factors we cannot control. Is there a particular time of the month that your board package needs to be prepared by? Will we make that deadline this month? We don't know when the board will meet. We don't know how long they will take to review your board package. Once reviewed, how long will they take to set up your interview? Once you have that interview, how long do they take to give you an answer? Because of all these unknowns, my advice to you is to get your financing in place, work on the board package, order your appraisal, get the loan approved, and then when all parties have a better idea of when you'll meet the board, we look to lock in the rate for a particular amount of days that should get us through closing with some days to spare. Another example, you're buying a single-family home and the on or about closing day is 45 days from the signing of your contract. Once the contract is signed, we can look to lock something in for 60 days, which will give you a 15-day cushion. But it's important to understand that it's just an on or about date, and each side can typically go 30 days past that date. It may or may not. Unfortunately, there's no way to know. So in the interest of full disclosure, you may lock for 60 days and not close within that lock period and be subject to a higher rate, at worst, extension fees to keep the rate, or at best, get the rate extended for free or even get a lower rate. So as you can see, there's no absolute correct answer as far as when to lock the rate. The best thing a loan officer can do is tell the facts, give the pros and cons, so the borrower can make the best decision possible. The vast majority of my clients have closed within their initial lock periods. Most who do not were because there were extenuating circumstances nobody foresaw, or they didn't listen to me. So as it may turn out, the one shiny object or interest rate that they have to sell you at the beginning of the process may either not be the rate you close with, or you have increased closing costs because you paid extension fees. If either of these scenarios take place, then I ask one simple question. Did you make the right choice when deciding on lenders? Before we finish up, there are a few more valuable pieces of information that I wanted to relay to you today. I made the point earlier that this process of obtaining a mortgage is not a commodity and shouldn't be treated like one. From my perspective, this is true as well. I take it very seriously that I'm helping and advising clients on the biggest purchases they'll make in their entire lives. That's a big responsibility, and I'm proud to do what I do. I view the loan as not a one-off transaction, and if used properly, can be an investment vehicle in your overall financial picture. Remember I said that the loan process is a jigsaw puzzle? Well, so is you and your family's financial well-being, each playing a part in determining your future financial health. I view myself, as you should as well, as an important part of your financial team moving forward. They include financial advisor, trust and estates attorney, CPA, loan officer, insurance representative. Because I view it through that prism, I have always cultivated relationships with each of these professions and have painstakingly created relationships with the best of the best. So not only can I add value by helping you obtain the right mortgage, I can also assist in recommending people from each category. This can have a massively positive impact on your life. All you do is have to ask, and if you don't, I will. So we've covered a lot of ground today, and hopefully we've opened up your eyes as to how the mortgage process works, educate you about some of the possible pitfalls, known and not so well known, how you can possibly avoid them, how CrossCountry is set up to not only better tackle these issues, but avoid them altogether, and lastly, how working with me provides value well beyond the mortgage. Once again, I appreciate you spending this time with me, and it was enlightening. I hope it was enlightening and educational.